From the morning reading, August ended with more than a 5% loss in the S&P. Since 1928, when the index has lost 5% or more in August, September supported a positive return only 4 out of 13 times, with an average of minus 5.4%. At its best point in September, it rallied above August's close by an average of 1.4%. But its worst point, it fell below August close by an average of 8.3%. That's a terrible risk-reward ratio. The good news is that from September through year-end, the S&P rallied 10 of 13 times, including all 8 since 1960, averaging up 5.5%. Its maximum gain averaged plus 9.1% versus a maximum loss of 5.6%. So, to pull all this together, in the short term, with the kind of August that we have, the probabilities would be, from a seasonality standpoint, that September would be quite negative, but that we would have a bullish end to the year. So keep all that in mind and keep it in context as just one of the things to consider as you put your trading together. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:58 a.m. Central Time, and I'm recording this in preparation for the market day of September the 1st, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's take a look at our overnight action, and we had some overnight action. Indeed, the ES is down over 2% at the time of this cut, as is the NASDAQ. The Dow right at 2% as well. The one from a relative standpoint that is holding up the best is the Russell at down 1.7%. So don't want to make too much of the fact that it's stronger, because when you're down 1.7%, it hardly seems appropriate to use the word strong. But it is of note that the Russell continues to hold up a little better than the other indices. And if you're thinking in terms of trading one against the other, the Russell seems to be holding up more consistently on a relative basis. But down 1.7% is still down 1.7%. Crude oil down big, down 2.6%. You have the euro up only 0.25%. The bonds up about 1/3%, and gold up about 0.8%. Overseas action is all red. China down 1.2, Hong Kong 2.2. Sorry about that. Japan down almost 4%. Germany down over 2%, and the United Kingdom down 2%. So very, very ugly overnight action for all of the U.S. indices and all of the overseas markets that we typically follow. In terms of the macroeconomic reports for Tuesday, we have just the, the ISM manufacturing PMI. And I think there was somebody speaking as well. I actually don't see it reported here, but I did notice on another report from the morning reading that there was one of the Fed members speaking today. So kind of keep that in mind. In terms of tomorrow, a little lighter report, but you do have the ADP non-farm employment change. Obviously, that's the prelude to the big monthly unemployment reports that we have coming out on Friday. You have the crude oil inventory report, and that should pretty much take care of it for the U.S. markets. In terms of volatility, we continue to have some pretty high volatilities. Notice the skew here, 130.38. So it's crossed that 130 threshold. And we look at this as anytime it's over 125, we start paying attention. When it gets up over 135, that is particularly dangerous. The VIX is at a 28.26 on the short-term version. IV percentiles 54, 52, 57, and 69. So kind of middle of the road, but higher than they have been in most of the recent weeks. Standard deviations, we did not have a standard deviation move put in yesterday, but it was also one of those trading days that was really probably pretty challenging, where, you know, 1 minute you're up 10 points, the next minute you're down 10 points. I mean, so the volatility is still showing, and that these intraday action and the movement is much wider than what we have seen in previous weeks, and yet at the same time it didn't actually accomplish much yesterday. Now obviously you know, substantial significant volatility in the last couple weeks, and certainly this overnight action where we are already down some currently we're down 39.75 points on the ES futures contract. So that, you know, tells us that we're likely to have a big standard deviation move for today. Now it reminds me of as we came into this pattern, you know, it was not a very pretty looking pattern, and sorry, just a second. That's what I was trying to get to. There you go. So we had this kind of reversal pattern off the bottom, but then we get up to the 50% fib retracement, and we seem to have a reversal pattern off the top. And certainly, if we use the ES, so we capture this overnight action. I mean, look at this. I mean, that is really coming down and looks more like a bearish continuation pattern as of this point. And this is really quite remarkable, because while this certainly was very bearish coming into the overnight action, it was also going into the face of the seasonality the first day of the month. And usually the first day of the month, and even into the second day, is bullish because of all the 401k money that comes in on the first day of the trading month. So that activity is going to be met with some really pronounced weakness for this action today. So a couple things to kind of think about there. So others are looking very much the same. Of course, this is the SPX. Here's the Russell, which has been, you know, seemingly looking a little bit stronger than the SPX, but still a very much a bearish pattern in the intermediate term, a reversal pattern, a weakening, and then a rollover. And we go to the futures version of this, and you see very much like the S&P, you know, a pretty pronounced weakness. You have the NASDAQ, same kind of setup, and the futures version of this, you know, it looks very much like that S&P, very, very bearish, and it makes you think that this could very easily go all the way back down and challenge and test these prior lows. So this you know, it could be shaping up for something bigger today. We never really know. As the day develops, we have to pay attention to what it tells us. But right now, I would, you know, I would bet a test of the bottom before I would bet a test of the prior range. This is really, really quite bearish. And then Dow, very much the same pattern. So all four of these are pretty much locked in concert in terms of very, very bullish kinds of, I say bullish, very, very bearish kinds of current action that we are seeing. In terms of our daily report, still trend breaking, still market in correction. The accumulation distribution score for the S&P did improve a little bit yesterday. It's actually a D, which is still horrible. NASDAQ an E. GMI index remains a 0 out of 6, and that author remains in cash, and in fact is rolling his retirement IRA pension type funds into a cash market as well. So very, very conservative approach by that author. You have the overall primary market condition is a neutral bull. but certainly is become much weaker than it was for most of the year. Decision point scoreboard still all very much down arrows, no change there. Intermediate term market posture, weakly bullish, and this actually strengthened a little bit yesterday. We have now all four the broad market indices as signaling weak bull, but it is just that, weak bull, and I would suspect that if we continue through with the overnight action, that these will be the kind of 1 and 2 day wonders on the weak bull side and will flip back over to bearish. In terms of position sizing opinions, still both opinions producing the same effect, and that is to be flat. So neither one of those would be encouraging you to take any kind of new positions, that's for sure. Hedge warning status remains rightfully so a level 3, which is crash warning kind of status. This means that the conditions are present that we could have significant downward action, though that is not the prediction or probability of significant downward action. Volatility-based metrics, market and decline, sharp increase warnings have both fired. VIX is over an 18, so that is a warning. We have our market in correction, so distribution day count obviously quite high. VIX phase is increasing, skews over 130. We did have in the New York Stock Exchange a very benign day, back-to-back now, only 68 and 30. So not a lot was actually achieved on the charts yesterday for those markets. We did have in the intermarket risk aversion indicators, we're currently 3 out of the 5 is risk off. And some of these were actually about to roll over and up, and be able to potentially with follow through cross to the risk on. But again, today's action is so remarkable already, I suspect that these will just turn and go back down the other way. Our special opinions, no changes here. Option income strategies, VIX is still outside the acceptable window, not a good time to be putting on new option income strategies. And just think about what happened last night. If you were in some sort of iron condor or something like that, and then you wake up in the morning and you're down 40 points on the ES, you probably are not in great shape on your iron condor. And even though you took additional premium in because the VIX is so high, volatility is so high, and premium is good, you probably have had a Vega and Delta position that has overrun that theta, and just not a great time to be putting on option income strategies unless you're a very, very aggressive and nimble trader. Covered call strategies, not acceptable to initiate new positions in this market, not even using in-the-money strikes. So consider at the very least this third special opinion, put selling. If you want to put on a covered call, think about selling a put and legging into that covered call cycle from that avenue, from the most conservative approach that you can. In terms of our special sector specific charts, a sea of red here, and really given the overnight action, probably would turn consistently red all the way across if we get follow through on today. You have from the sector percent change, only one was positive yesterday. Of course, energy was putting in the major day, but that seems to have been all given up today, and the overnight action, so that seems to be very, very negative. And I imagine the energy sector will take quite a hit on the open today. So and we continue to point this out, but if you stretch across the time frames and you look for consistency of performance, the consistency of performance is to the downside, not to the bull side. So very important to start keeping that in mind. And we're probably right on the verge of flipping and starting to look, instead for bullish entries and so forth, that we look to initiate more bearish trades, and do that on a consistent basis, that we switch over to a bear market stance. So not quite in a position where we can just unequivocally say we're in a bear market and not have it rip our faces off with a big bullish day yet, but we certainly are starting to have that stance where we're far more likely, and we are indeed already at the point where we're more likely to look for bearish than we are to look for bullish. So that should be enough for today. As always, if you find this helpful, like us on your YouTube channel, subscribe to us on the YouTube channel, retweet us to your Twitter followers or your StockTwit followers. Obviously, Scootify, we're there as well, Facebook as well. Greatly appreciate your sharing the voice forward with your own trader friends. More information can be found at this website for how we model these trading approaches into our own accounts. Disclaimers as always. Hit the pause button if you need more time to review those. And we'll see you back here tomorrow morning for the market preview. Good trading.